morning, New York, and good afternoon, Zurich, and good evening, people who are in Bahrain, Saudi, GCC, and Asia. Thank you for joining us today. It's a great pleasure of having this webinar with Jonathan Berger, who is the founder of Birch Capital. This webinar is going to be discussing around credit markets, the new equilibrium that we are seeing, and that is a collaboration between the family office and Petiole Asset Management. Just a bit of 2 words on the family office, multifamily office with local operations in the GCC, an office in Bahrain and Saudi and UAE, have been operating for almost 20 years and serving families in the GCC region and investing in a very institutional manner internationally and providing a very easy digital access to co-investments and thematic investments. With Petiole, we are the asset manager based in Zurich, also with offices in New York and in Hong Kong, and we are focused on private markets. But at times we look at the public market dislocations, and in this case, credit market is one of the asset classes that we believe is dislocated and we'll be discussing today. Jonathan, he is the founder of Berger Capital. He started this business in 2013, and ourselves, we partnered with Jonathan from the beginning until now. So it's been almost a decade relationship with Jonathan and his team. Before that, he was at Stone Tower Capital as the chief investment officer. And he has had experience in public credit, in structured credit, and in distressed as well. So today we're going to cover the overall credit markets, the areas that he looks at, how he's seeing the market environment today, how are we looking at potential dislocation in this market, exploiting those dislocations, and it's going to be a super engaging and fun webinar, I'm sure. So, Jonathan, pleasure to have you. I know you're in New York, so good morning to you.
Thank you very much. It's an honor to be here, so I really appreciate the time and happy to give you my thoughts.
Great. So before we start, maybe you tell us a bit about how you started, Birch Capital, and how this idea came about, and really, what is it all about, Birch Capital today?
Sure. So I started Birch Grove, as you mentioned, almost 10 years ago, after having been the CIO of Stone Tower Capital. And prior to that, if you kind of go back through my career, I've been investing for over 30 years, and really started out my career in 1991, working as an analyst in a very small shop doing distressed investing. And I had the opportunity to go into investment banking for a bit, but I really loved investing. And I think the basis for Birch Grove was really to focus on what I love to do, which is investing in companies across capital structures, with a view that markets change and values change across different segments of capital structures. And I wanted to approach investing in an agnostic way such that I could make money in all different market cycles. And I wasn't beholden to one particular asset class at any one time. So that was the very, sort of basic philosophy of Birch Grove. It came out of what I had done just previously at Stone Tower, which we took Stone Tower through the financial crisis. And I think that was a tremendous learning experience, managing a business that had many different components, from structured credit, corporate credit, liquid credit, private credit, and watching how all those asset classes moved around during the financial crisis, where the risks were and how that impacted the business. And I was able to use all that to help create this business with my partners and colleagues 10 years ago. And today we've built a business that's about $7 billion in assets that invests across liquid credit, private credit, and structured credit.
Great, thank you. So let us start with some of the lessons learned, maybe, of the last decade that you've been investing, that helped you, let's say, refine the investment process.
Sure. I'd even take it back maybe even a little farther. Some lessons that I learned, back in my days as a distressed investor at a firm called Pegasus, where, and I would take these, some of these lessons and apply them today. For example, I've been through bankruptcies, both on the buying of companies through bankruptcy, but also watching companies I've invested in go through bankruptcy. And I think one lesson that I try to apply across, all asset classes is to manage liquidity and risk. I think it's very important that if you're going into something that is, illiquid, and that's okay. I think illiquidity is fine. You need to make sure you're getting compensated for that liquidity. You need to make sure you have the appropriate return profile, and you want to also understand what is your exit time frame and what are your exit mechanisms. And I think the reason I bring that up is, there have been situations, or one in particular I remember learning from in my mid-20s at Pegasus, where we were involved in a situation where we were illiquid at the bottom of the capital structure without any time horizon or control. And I would say that was a very bad investment. And I try to avoid being in those types of situations, today. And I sort of take that philosophy and think about liquidity versus risk versus return across every asset class, be it high yield, structured credit, or leveraged loans.
Very well. And what are some of the asset classes or sub-asset classes within credit that you look at? Maybe we can define those.
Sure. What we think of our skill set is looking at primarily companies, corporate capital structures in North America. And I would say to some degree Western Europe, but I would caveat that by saying, and if we're looking at European credits, it's probably on the liquid side only, versus in North America, we're looking at both liquid credit and private credit across the capital structure. So leveraged loans, floating rate secured loans, secured and unsecured bonds, be it investment grade or high yield, as well as corporate structured credit, so CLO liabilities and CLO equity, so collateralized loan obligations, basically securitizations of corporate credit. That would be our skill set, and that's really what we focus on and look across in different market cycles.
Okay, and then if you look at the rising rate environment that we have witnessed last year, and I would love you to talk a bit about last year volatility, how you manage this, but just for a second, if we take the rising rate environment and assuming that interest rates are going to be sticky at these levels, which is no longer the low rate environment we lived in, how does credit market and the credit asset classes behave in a high rate environment, and what the changes that you might want to apply today versus the last 10 years, which you have been operating in?
Sure, and it's very interesting, to look at these different credit markets in this high rate environment, because in maybe previous environments where we had higher rates, which you have to go back pretty far, credit quality amongst the different asset classes was very different. So, today, let's just look back at 2022 and what happened. For example, we saw in 2022, in the first half of the year, with the very big move in rates, with inflation, fears of inflation, the war in the Ukraine, rising energy prices, you really saw, a very, very large move in fixed rate credit, particularly both investment grade credit and high yield credit. And if you look back, you had, very large drawdowns in those asset classes because not only were they connected to the rates market, but people had, or investors had concerns of the underlying fundamentals, and what a high inflationary environment would do to the underlying credits, particularly in the non-investment grade segment of the market. If you step back a bit, though, and think about the high yield market, which would be the non-investment grade segment of the fixed rate market, the credit quality of that market has actually been improving over the last 10 years since the financial crisis. That market has increased in ratings quality. It has reduced leverage, and what we've seen is a shift from the fixed rate market to the floating rate market. We've seen a significant growth in leveraged loans, in collateralized loan obligations, and you might argue that as a market, the leveraged loan market has a lower ratings or lower quality. So now, as we step back and look going forward, the initial thought today would be focus on, be it whether it's in the leveraged loan market or the investment grade market, what we're focused on are situations, individual situations where capital structures can be sustained through a recessionary environment. I'm not sure we're going into a deep recession. I think it probably will be more of a shallow recession. I don't think it's a no recession. I do think we're going to be in a higher for longer rate environment, which we're already seeing has impacts on companies. So defaults will go up. And when I think about how we invest in this environment, first and foremost, I'm looking to make sure that we have sustainable balance sheets and capital structures, and trying to avoid restructurings in this environment. We can get into why that is. Now, with respect to fixed rate versus floating rate, we've tended to shift into the floating rate side, notwithstanding the fact that I just mentioned that the leveraged loan market may be lower quality. The floating rate market provides actually a higher current yield in this environment, as well as a dollar price that is discounted in the let's say low 90 cents. So it's an environment where if you get the credit call correct, you get a high current yield as well as capital appreciation. And there aren't that many moments when you can do that. And so what we've seen is 2022, the leveraged loan market was basically a flat market, where the high yield market was down about 11%. And even today, the leveraged loan market's trading at close to a 10% current yield, and the high yield market's trading at a high 8% current yield. So I'm not saying that I always will like leveraged loans over high yield. It depends. When we saw last year, there were moments in time, extreme moves like June and July of last year, where the high yield market moved significantly and spreads widened out such that on a relative value basis, high yield looked probably more attractive versus leveraged loans. So we watch that relative value very closely between these markets. But today, I think one way to invest in a higher for longer environment is to be in floating rate assets in situations where you truly believe you're in sustainable capital structures and balance sheets.
Got it. So if we think about sectors or industries that you are avoiding because you think there might be challenge in this environment, what would that be, and the sectors that are you're favoring?
Sure. And sectors, it's interesting, in the non-investment grade credit world, sometimes sectors, each company is different because balance sheets are different within sectors. But I will say that, you could, the tech sector, for example, we've avoided a lot of the tech companies, which, like the equity markets, the credit markets financed a lot of companies that were not profitable or were in early stage profitability. And we may not have avoided that completely, but we've generally tried to avoid sectors and situations where you don't have sustainable, free cash flow. It's hard to avoid the impacts of a high rate environment or an inflationary environment. But there have been parts of the healthcare market where labor has been a big factor, either a shortage of labor or high labor costs. We've avoided segments of that of healthcare. Areas that have been I think done well. The insurance market has done well. Business services have generally been somewhat insulated. But I would say, most of the companies that we look at, we've seen the impact of the inflationary environment. The question really is, how impactful is it on their balance sheets? Can they sustain themselves, and are there levers that they can pull to make it through a recessionary environment? And we have seen in the last quarter, while many companies have missed revenue targets, they've beaten their EBITDA targets because they've actually been able to implement cost savings, and actually implement more cost savings than they have targeted or telegraphed to the market. And this is maybe more specific to the leveraged loan market, which is more of a private over-the-counter traded marketplace. But I've been happy with many of the underlying companies and their performance, not on the revenue side, but mainly what they've been able to do on the cost side and cost savings and passing on prices through to customers.
And that cost saving, because we haven't seen unemployment picking up, is it mainly through digitization? And is that what you're seeing, is much more efficiency in running those businesses?
I would say it's yes, there is a combination of efficiency. I think they've, all across their business, they've looked, I think during the period of zero interest rates, companies were spending money. They weren't thinking as much about their budgets. In an environment with higher rates and higher inflation, these companies have really had to tighten their belts and sharpen their pencils and focus on excess costs. And I think it was a combination of technology helping and accelerating the savings, but also companies actually looking at where they were overspending. And we've even if you look, take an extreme example, look at the unprofitable tech sector, which we've generally avoided. You're seeing companies in that sector really changing their business models rapidly, and instead of focusing on revenue growth, trying to focus on profitability. And there, big examples of that could be like an Uber, where we've seen them move from losing money to making money at the EBITDA level. I would say we'll probably see more of that in the tech sector, but it will be a painful process, because there are probably some companies that their business models will never be profitable.
Yeah. I remember when it was, during COVID times, we had outlined a strategy that we are doing similar to now. And it was a strategy to play the credit market because it was dislocated. And in our case, when we think about relative value, you think of it as high yield and loans. We think of it as maybe private debt and credit, right? So that's like how much liquidity premium we're getting by being in private debt, or by transitioning this allocation to more of a public credit. In that case, we noticed that you can buy credit on a discount, quality credit, and build a portfolio together to play this dislocation. And it was also on the premise that potentially there will be a reopening, but then we went into the phase of buying quality credit, strong balance sheet, until the reopening happened, and then we took maybe less quality credit, and then we get paid a bit more, but we knew that the market have reopened. And one of the theme that was in this portfolio was the consumer kind of theme coming up again, and due to the reopening, the consumers will have to spend again. Now, recently we outlined the same strategy. We saw this coming again, and we're doing it together as a credit dislocation program, buying those discounted credit. But the question for you is around the consumer play, because what we have seen, consumers have gotten a lot of money during COVID, and now when you look at the numbers, they are using more credit to buy. So yes, we're going to be facing a mild recession, but what's your view on the consumer weakness? Because we haven't seen yet that pain from the consumer. And is that something that you are spending time on, not just from the quality of the balance sheet, but the type of businesses that are maybe exposed more to consumer businesses? So love to hear that.
Yeah, you're correct. I mean, we do spend a lot of time on consumer companies. What we've seen, the high-end consumer businesses, or businesses, consumer companies that are more experiences versus goods, those have done well even in an environment where you've seen high inflation. Prices have been able to pass through to that segment, both of consumer as well as type of company. Where we've seen more pain, and where I think we have to watch closely, is the kind of lower end consumer, where inflation, whether it's high food prices or high gas prices, had more of an impact on their wallet, and really had an impact on the ultimate companies that would sell to them. Now, with energy prices coming down a bit, that has given a relief to that low-end consumer, but there's still inflation, food inflation, and as we see the housing market starting to take a hit with higher mortgage rates, while many of those consumers don't necessarily own, it has an impact on the rental market, which has been at a fairly high rate for a while. And so we've been much more concerned about the lower end consumer, where lower price points really matter, and we're watching that closely. We have seen a few bankruptcies recently. We've not been involved. Those are a combination of competitive landscape, like a Bed Bath & Beyond or a Party City, not so much about the low end consumer. But you have to also watch, there's been an acceleration in the secular changes in the consumer market. So COVID obviously accelerated the use of buying online, and we're starting to see that impact in many of these companies. So while you're right, when we went through COVID, we kind of outlined phase 1, phase 2, phase 3 companies, phase 1 meaning ones that really weren't impacted, phase 2 meaning companies that were impacted but would recover, and phase 3 impacted but not recover. Now we're starting to still see some of those phase 3s. It's taken a while, but they haven't fully recovered, and their business models are not sustainable. I would say many of these unprofitable tech companies, they're really consumer companies that mask themselves as tech companies. A Carvana is a good example. A Vroom is a good example. These are companies that the business models are not necessarily working in this environment. Party City and Bed Bath & Beyond, old line type companies that are, business models not really working going forward. So we have to be very focused on that as well, in addition to being concerned about the low end consumer. But the high price points, I think, have done well. Experiences are doing well. So the restaurants are doing well generally, even though you've got high labor costs as well as high food prices. People are going out to restaurants. The gym segment, which we've been very involved with, has been recovering as people go back to the gyms. And now it's actually been more of a delayed recovery, but now we're seeing it, particularly this quarter, where we don't have any real COVID issues impacting like we did in the first quarter of last year. We're seeing the health club gym segment truly recover, both with the public companies as well as the private companies. And we have some exposure there, and I think there's some upside in that segment of the market.
What's your view on healthcare and related, whether within the sector?
Well, many of the healthcare companies or healthcare service businesses, have been impacted by labor, and they have many of them have an issue because there's a regulatory regime that puts a cap on their revenues, so they can't pass prices through. But there's no cap on their costs because labor prices are going up now. So what we're doing is we're looking for situations where that spread compression has impacted earnings, but yet companies can sustain their balance sheet. So there's been sell-offs in their debt, but yet we don't think they're bankruptcies. And so we've been actually focusing on areas where within healthcare where there's been an impact, but yet they can make it through a recessionary environment. And possibly even in a recession, we will see the labor costs come down, and we'll see, instead of spread compression between revenues and EBITDA, we'll see that decompression. We'll see cash flows improve. So we've been looking at those areas, and I think there's healthcare has been one of the worst performing segments of the credit market in 2022. But I do think there's a lot of opportunity within healthcare in 2020, 2023, and 2024.
And it might be less hospitals and labor heavy, but more maybe life science, I don't know, clinical research organization, things like.
It could be clinical research, but I think even in the staffing side, which is a labor segment, I think in staffing, we've been looking at the staffing segment of the market because there are positive secular changes in the use of those staffing companies. The problem has been the labor costs. The demand is there. It's the supply that's been a problem. But as we see more maybe weakness in the labor market, the supply side of that segment of the market won't be as much of an issue. And so, yes. But where we're focused is in most of these segments is staying at the top of the capital structure, in secured debt, in floating rate debt. So when we look at these types of situations that have been more impacted, we're not going down into the capital structure, into the junior parts of the capital structure as much. We're still staying top of the capital structure so that we can withstand more volatility.
Got it. Do you have a phase 1, 2, 3 that you can think about now and in the next years? Like assuming we start this year with phase 1 being the high rate environment, do you have that playbook in your mind?
Yes, we've been thinking it's a little bit different than COVID, but yes, it's that. And I would say phase, we implemented that again kind of after the second quarter of last year, because the second quarter of last year really is when you saw a very large drawdown, pretty much in all markets, equity, investment grade, high yield, converts, structured credit, because that's where you really had this realization that, inflation was not transitory. It was going to be here for longer, and that the Fed was going to have to really attack it and maybe go beyond where they would want to be and potentially send the economy into a recession. Now, it hasn't happened yet, but the Fed, and we've seen since that time, both a complacency sometimes in the markets as well as the markets being overly cautious. But from that moment in time, we focused on phase 1, phase 2, phase 3. Phase 1, in our mind at the time, were companies that really had very little impact on their underlying businesses from inflation or rates, but the market was selling off and everything got sold off. Many of those names that traded down 10 points, they've traded back up again. So phase 2 is more like what I'm talking about even in healthcare, where it's impacted businesses but sustainable balance sheets. And phase 3, again, would be impacted businesses but not sustainable balance sheets. And I'm very negative on distressed at this moment in time. I'm avoiding restructurings. because there has been a secular change in the distress market over the last 10 years because of the weakness of documentation, and that there's an ability for what we call lender-on-lender violence, where you can see constituents and capital structures able to outwit each other, and even within a similar tranche have very different recoveries. And so we've seen it. It started pre-COVID, but it happened more during COVID, and it's starting to happen again. So I don't think you're getting compensated in the distressed market for that potential lender-on-lender violence. And so those phase 3 names we are avoiding and really trying to, as opposed to leaning into them. Now, where we would look at them would be on the private credit side, where we would provide new capital to a situation that is going through restructuring or bankruptcy. I think on the private credit side, which we can distinguish from the liquid credit side, solution capital is a very interesting place to be, because the private credit market is now $1.5 trillion and default rates are going up, and providing solution capital in that market is attractive. And we're finally seeing, unlike last year, we're finally seeing spreads widen in the private credit market, whereas last year there was a lag between where the liquid market was and where the private market was.
Yeah, I mean, if I was to relate on the way we have outlined, and I think because of maybe working together for such a long time, we kind of follow a bit of same mindset. But so what we have done in the summer of 2022, we have also laid out a phase plan between phase 1, phase 2, phase 3. And phase 1 for us was overweight credit, underweight equity, because we're relatively playing across credit, equity, and asset classes. And in that phase, we spoke, and then we found that the credit market is much more attractive on the public side versus private side. So we executed on that strategy, and we are still executing on the strategy, which is where you can achieve private equity returns by being in the public market, and that's through our dislocation thematic plays. So we've done that, and now we started our phase 2. Phase 2 is more overweight credit, still overweight credit, but also starting to go neutral equities. And in this case, what we have seen on the credit side, like you said, private debt, which is an area we haven't been investing in for the last 2 to 3 years, is becoming more attractive because the pendulum has swings from being a borrower friendly to more lender friendly. So we are doing more. We're accelerating a bit the private debt in phase 2. We're accelerating also private equity, even though we haven't seen yet a homogeneous valuation across the board. But now you can start doing security selection and really find businesses that have repriced similar to the public market, even more. And where one of the themes that you have mentioned, Jonathan, is that you focus on the core business in difficult market environments. So one of the themes that we have seen more of is the carve-out theme, where as a core business, you have to sell some division because you need to focus on your core assets, and that division usually is mismanaged. So we playing that, and that I think is the pickup of carve-out in our portfolios. So we're going through that neutral allocation, and some of the private equity deal flow we're seeing is also on take private, so publicly listed companies, more cheaper. But there is still this arbitrage that you can play between public and private. It is not fully priced in the public side, and some of it is coming to the private side, like private debt, like private equity. But we're still in that inflection point where public is attractive, especially on the credit side, and that's the reason we're playing it. And one of the areas we haven't touched on is the CLO market. We have been partnering on this together. I would love to hear your thoughts on CLO debt and equity, whether it is secondary CLO or primary issuance.
Sure. Well, it's been interesting because in the last quarter of last year, you mentioned CLOs, and the CLOs represent let's say 80% of the buyer base of the North American leveraged loan market. So they tend to generally move in concert with each other, and they to some degree drive the technicals of that leveraged loan market. And in the last quarter of last year, with a move in rates, with a sort of a risk-off approach, we saw very little CLO creation. We saw buyers sort of holding off even in their warehouses, adding assets, and a decline in asset prices of leveraged loans. It became very attractive to step in, both utilizing warehouses, utilizing CLOs, and utilizing just unlevered accounts to go in and buy leveraged loans at that point in time. I would say even with the move in leveraged loans that we've seen along with other asset classes in the first month and a half of this year, leveraged loans still are trading at a very attractive level relative to the fixed rate market. There's still a big discount. The overall market's at, let's say, 93, 94. The overall yield of leveraged loans unlevered is close to 10%. And so that means there's a lot of opportunity even within that market to construct portfolios that are very attractive, that have upside and income. So the CLO market itself, the whole capital stack to me is probably one of the more attractive areas within credit. You know, if you're an insurance company and you want AAA exposure, the AAA part of the capital stack is priced at, you know, kind of SOFR 170 to 200 to 220, and that is a range that's 6-7% depending on what discount it is, and so that's a very attractive AAA. And if you kind of go down that capital stack all the way to the BB component, BBs are running at yields of almost 15% today. For very diversified portfolios, again, you have to believe in the underlying credit. So I think that CLOs have lagged the move in the rest of the credit markets, and everywhere in the capital stack, including the equity, is attractive. Now the equity is attractive because you can really, if you're an active manager like Birch Grove is, we can actively trade in and out. We can build value through credit selection as well as trading, and there's a lot of opportunity for reinvestment during periods of time like this when assets are discounted. So I think every part of the capital stack is very attractive and probably lags the rest of the credit market, even lagging a little bit the underlying assets that go into those CLOs. So I think that will change, and we've already started to see a move in CLO liabilities starting to tighten from the end of last year to the middle of February. But I do think we've kind of hit a level where they're not going to tighten much more. They're going to stay at this level for a period of time. The new issue loan market, to your point on private equity and M&A, it still hasn't grown significantly because there is a bid ask between where private equity buyers want to buy companies and where sellers want to sell companies. And the M&A market to some degree drives the new issue supply. So it hasn't grown yet. But if we see a growth in supply, we could see another step back in the leveraged loan market, another step back in the CLO market, providing additional entry points. But generally speaking, I would say the whole capital stack in CLO liabilities is very attractive, both on an absolute and relative basis versus the comparable credit quality in other areas.
Okay, and maybe you talk about convertible, because that's also another area you look at, and maybe define it first and then say how you're playing it.
Sure. So, we look at convertible bonds like we look at every other credit asset class. It's a way for us to invest in a particular idiosyncratic credit. if we go back last year, a lot of the convertible bond market or converts financed many of the unprofitable tech companies. So even though we avoided those situations, the market was filled with them, be it the Lucids or Teslas of the world, or Carvanas or Vrooms, or Beyond Meats. You can keep going. There are a lot of companies that were financed in the convertible bond market in 2021 with very high stock prices. Those, in the first half of 2022, those stocks got hit. The converts basically had a perfect storm situation. They traded off because the underlying equities were down. They traded off because the rates market and spread market moved up, and they became a credit product that was based on spreads, and the spreads had to widen out. And they also had their buyer base sort of disappear overnight because many of those buyers had bought bonds at very high dollar prices. So there was a moment in 2022, let's say July, where the convertible bond market, or many of the names we were investing in, were actually trading at 300 to 400 basis points of a discount to the comparable high yield bonds, even in their own capital structures. And that's where we stepped in and added more exposure in converts. We had some converts already that were event driven. They traded off. We unwound, though, our short positions, because we do sometimes short the equity against the long convert. But we then went outright and owned the converts and bought them in the third quarter of last year, end of second quarter of last year. And in the next 2 quarters, including the first month and a half of this year, we've seen a big uptick. And those converts have probably now traded in line with their high yield counterparts. And what we've been doing actually is reducing our position, because they've moved up too much, such that their current yield is no longer as attractive as either the equivalent high yield bond or a leveraged loan. So we've used the run up, we've taken our gains, and probably have reduced exposure in converts from 30% of our portfolio to 10% of our portfolio. So a pretty big move. And what we still own would be higher yielding idiosyncratic names that I would say look more like high yield and much less like a convert. I would say we probably did that same shift even in high yield in the first month of this year, as the fixed rate market moved a lot faster than the floating rate market. And we've done a lot of swapping from fixed into floating rate and increased our current yield in the portfolio.
Great. I'm looking at time. We are at 40 minutes, 43 minutes. So we try to get closure here. So I think the way you're describing your approach, if I summarize it correctly, you have this view that is a phase 1, 2, 3 view of the environment. And you are, within your approach, you're always assessing relative value between the various credits. So convert from 30% to 10%, high yield, leverage loan, today more leverage loan, but you used to be in high yield. So this has this whole relative value between credit. And the last thing is much more focus on credit selection. I mean, at the end of the day, you're selecting companies with the right credit and getting paid for this selection. And in this environment, you're avoiding distress, which is, in our world, we say, we're avoiding complexity and we're favoring simplicity because, the market have reopened. So I hope this was a good summary of the approach. I would love to ask you 2 more questions, more personal. One is, who would you say, or if there is a mentor that have helped you throughout these years, and what have you learned from that mentor, would be great to know this. And the second one is, if I am a young professional coming into this industry, what are the 2, 3 things that you've learned over the last 30 years that you would say apply those that they have worked for me.
Sure. I might be able to answer both questions even with sort of one type of answer, in that I have a few mentors in my life. I think one important point for a young investor or somebody getting into the business is to find a mentor and to develop a mentor. You have to develop a mentor. It's not as if they just appear and they offer you their advice. You have to, some ways, prove yourself to a mentor, but find someone who you respect and value. And I've found that having multiple mentors over my career has truly helped me. I will say, I won't say the name, but one of my mentors was someone I started working with very closely when I was at Solomon Brothers, and he was at another investment bank. And then when I helped to found Pegasus, he was in another investment firm, but we invested very closely. And one I'd say important philosophy he taught me, which is what I would impart to anyone, is to, and I say this a lot, is to be agnostic when thinking about investing. It sounds simple, but don't have a bias on anything. Really try, it's almost simply saying don't fall in love with anything. Really have an open mind. And where I see investors breaking down is when they have a bias to do something. They feel like they have a particular expertise in something and they must always do it. That's where you get into mistakes. Or a particular love of an industry or a company. I really try and impart on the team, particularly the younger members of the team, that I really, I would be very happy if one analyst said to me, don't put a single name from my sector in the book at all this year because they're overvalued and we're going to lose money. Versus someone thinking they must have a name in the book and that's how they make money. To me, it's about their making the right call, not having assets in the book. So I bring that back and say, for people getting involved today, yes, have a mentor, but really try and be agnostic when thinking about investing. Be open-minded, and really do not fall in love with anything, even if it's, even if you have an expertise in something and something in another sector or industry or asset class seems so foreign to you, have an open mind and learn about it. And I would also say that all aspects of your life contribute to being a good investor. It's not just about the business part of your life, particularly today, with the understanding of everything that's going on in the world, the political landscape, what you read, the arts. I actually think that all contributes to you being a good investor. Being able to step back from the details of something and the weeds of something gives you perspective, and perspective helps you become a better investor. So these are some of the philosophies I try and live by, and I would say, the mentors I've had have helped impart those on me, and I really try and impart those on others in my firm as well.
That's great. Thanks, Jonathan. So just to wrap up, on our side, as I mentioned, we've been partnering with Jonathan and his team for the last 10 years. We hope we're going to continue that partnership over the next 10 years, if not 20. We're expressing certain themes, ideas, dislocation that in this current market environment, I encourage you, if you'd like to learn more, contact us, and we're happy to assist you on how to exploit dislocation and efficiencies in an environment that's going to be much more challenging, volatile, but you need to have the right skill set and the right partners to work with. On this note, Jonathan, thank you very much, and we speak soon.
Thank you, Naji. Thank you very much.